There we go. Now we are recording. My name is Matt Delaney, and I am the managing partner with JDH Wealth Management. And I just appreciate everybody taking the time to jump on this call. I know a lot of you are working from home in different areas, so I appreciate you taking the time. I would first like to thank Lynn Mosier with Buckingham Strategic Partners, who helped us put this call together, and obviously Larry Swedroe, who I will introduce in a minute here. But a couple of housekeeping items, as we have quite a few people still joining us. I have muted everyone, so if you can just keep in the muted, make sure it's muted to make sure that we don't have any background noise. If you have a question in the lower part of your screen, you can select the chat button and you can submit a question there, and we will make sure we try to get all of those answered. We will be recording this. We have quite a few people asking if this is going to be recorded. It is. We will send it out after the call. So rest assured, if you have to jump off the call for some reason, we can send this out afterwards. Okay, to the business at hand. We are certainly living through interesting times right now with the market swinging wildly every day. We actually have a great privilege. It's an honor. It's a friend of ours. His name is Larry Swedroe, and he is the Chief Research Officer with Buckingham Strategic Partners. He's authored and co-authored over a dozen books. He's been featured on television shows such as NBC, CNBC, CNN, and Bloomberg Personal Finance. He holds a degree in finance and investment from New York University and a bachelor's degree in finance from Baruch College in New York. Larry, I know you are extremely busy, and I appreciate you taking the time just to talk to us today. There is obviously a lot of noise, like I mentioned. You cannot turn on the television or open up any sort of online article without hearing doom and gloom, negative news. So obviously we're getting a lot of questions from clients right now, and we thought this would be a perfect opportunity to have you talk to us about why it seems like the world is falling apart, and why don't you set the stage for us, and I'll let you take it from there. And let me unmute you here. There you go.
All right. Thank you very much, Tim. So just so people have a little bit of background on me, I've spent now 46 years giving financial advice on management of all kinds of risks to some of the largest financial multinational corporations in the world. I've run trading rooms for two of the largest financial institutions, both foreign exchange and interest rate risk. I've been a chief credit officer for the largest mortgage bank, and for the last 25 years, been the head of research for Buckingham Strategic Partners, working with tens of thousands of individual investors, large institutional investors, and as well in managing risk. And I mention that because that experience has allowed me to live through about 20 major crises like we are experiencing today, although each one is unique. Each one at the time seems like the world is coming to an end, and people feel it's always darkest, not before dawn, but before the storm is about to really hit. And I'm willing to bet that there is not a single person on this call who could name maybe 50% of them. And as a good indication, I would just ask you to think, could you name the bank who, in I think it was 1984, was the sixth largest bank, and it in the United States, and it failed. Now we didn't even have anything like that in 08 or 09. Certainly not today, as I'll touch on. And I'm willing to bet there's maybe nobody on this call who can name that bank. For your own interest, it was Continental Illinois. And imagine how bad the markets would be doing now if one of the largest banks had failed, or if that had occurred in 08 or 09. So I've lived through all of these experiences. That gives me a perspective on what happens. How do we get out of them? Should we expect to get out of it? How long does it take to get out of it? This is always an unclear crystal ball. And I would urge people, if you hear forecasters who tell you what's going to happen, you definitely want to ignore them because they don't know what they don't know. The smartest people always talk in probabilities. If you hear somebody talk about, here's what might happen and here are other possible scenarios, you know that person is intelligent and you should be listening to them. With that said, as just a backdrop, given the crisis, I thought I'd mention right up front three key things, or three legs of a stool, you might think of, that I think are critical to help you think going forward and in a more positive light. Number one is in '08, as we headed into that, the US banks were in very weak shape with relatively low capital levels, massive exposure to very risky assets that were about to collapse in value. We have exactly the opposite situation today. US banks are the strongest capital positions they have ever been in. They have almost no investments in inventory of risky assets for their trading accounts. That was eliminated by the Volcker rule. So any losses there are now going to be tiny. What is a problem though for banks in the short term is negative interest rates. Today, the T-bill rate actually dropped below zero, and not to scare anybody, but that might mean if rates stay down for at least 30 or 60 days, your money market account could drop slightly in value if it's holding T-bills. That has to happen unless the government were to put a floor on that, because you would be losing slightly interest rates and value because of your desire to hold the safest asset. The only thing that wouldn't drop in value would be cash in a mattress, because even banks could decide to charge negative interest rates. We've even seen negative interest rates in mortgages in Europe. So it's hard to tell what will happen, let alone what can happen. If we have questions about that at the end, I'll touch on that. But the key point I want to raise is the banking system is in incredibly good shape. And yet today, the banks are trading at levels they were at during the great financial crisis, when many of them were likely or might have gone out of existence. Earnings were slaughtered. And so investors may have overreacted here. In fact, thinking about that this world will be, instead of a V-shaped recovery where we go down sharply and come back, which is one possible scenario I'll talk about. Another is a U-shaped recovery where it goes down, bottoms, takes a while to recover, and then starts to come back. And a third is we end up looking like Japan, where you bottom out and never really recover. You just stay at a very low level. And I can't rule that out, and we can talk about that a little bit. So number one, banks are in a great financial position. They're key to the economy because their ability to lend is what greases the whole economy. Number two, the Federal Reserve has learned from the lessons of '08, '09, where in that period, they took months to drop rates to zero, inject liquidity, prop up the commercial paper market, and they pulled out even bigger guns this time, and immediately, within 30 days, we've got, and really just in the last 2 weeks, when this really unfolded, they are now accepting all kinds of collateral that they didn't take before to provide liquidity to the system. They're buying up things like municipal bonds. I'm willing to bet there's a good chance they'd even start to buy corporate bonds. We have precedent for that in Japan, meaning high-grade corporate bonds, to provide liquidity for banks and other insurance companies who might be holding those assets and need liquidity. And if there's no buyers for that, those prices also could collapse, or they can't even be sold. So the Fed has pulled out basically an unlimited amount of liquidity. And this is also true of all the central banks around the world. This is happening in a coordinated and very prompt process. Second leg of the stool or the third leg of the stool, in addition to the banks and the central banks, in our case, the Fed, is fiscal policy as opposed to monetary policy. We took a long time to get a stimulus bill passed, and maybe it wasn't enough. We had to do rounds of it. Here we're getting it all within a relatively short period. I just saw on the TV, lead Democrats expect or hope to get that bill presented by this afternoon. So we're getting very prompt action and much bigger scale immediately than anything we saw in 08 or 09. And just to give you an idea, I think roughly a $3-4 trillion economy we're talking about. This could be a $2 trillion bailout effort, which would replace the demand that is lost by people who would be unemployed and can't spend. That's the key. You've got to, it's not enough to provide liquidity. You also have to replace demand. And that is being pumped out with all kinds of programs, unemployment insurance, forgivable loans to businesses if you keep your workers employed. I'm sure there'll be packages, we don't know exactly what they'll look like, to the airline industry, which will be long-term loans, which will probably could be convertible debt. We don't know, to give the government a return on its investment and protect the taxpayers. So we're seeing three big guns really being bazookaed out there all at the same time. And that's why you're seeing, if you're wondering why, despite the medical crisis is nowhere near peaking, the stock market right now, the Dow is up almost 10%. And by the way, just on another note, imagine the investor who panicked and sold yesterday, now looking at the market up 10%. I don't know what's going to happen tomorrow, but let's just hypothesize that it goes up tomorrow. And now what do? The crisis is still here. We'll have medical, problems for months. And I'll talk more about how the economy reacts, but there will never be a green light that will tell you it's safe to get back in. And again, I'll touch more on that. So one of the things we want to do today, hopefully, and that's the role of a good advisor, is to help you stick to your plan, which already incorporated the certainty that we would get events like this. We just don't know in what form. We don't know how severe or how deep they'll be or how long they'll last. But this is now the fourth 30%, 35% drop or more in the last 40 years. So that's 1 every 10 roughly, which means if you're 65 years old today, you should be planning at least 30 years if you're healthy. That means you better expect maybe 3 more of these in your lifetime. So your plan and working with Tim and Matt, your advisors, has to incorporate that already, as I'm sure it is there. So you shouldn't be panicking because you should have that plan in place. Okay, that's the background I wanted to give early. Let's talk about what's going on right now. So before the crisis, the volatility in the market is measured by something called the VIX, the VIX. It's a volatility index. Historically, volatility has been about 20. However, in good times, normal times, volatility tends to be much lower. So as we headed into this year and right up till February, we were trading in the 14, 15 level. So less volatility than the average. Just to show you how severe this crisis has been and why you're feeling afraid and scared. Last week, every single day, volatility exceeded 80, or roughly 6 times what it was at the start of the year, and just shy of the all-time high, which it reached at the peak of the crisis in 08-09, which was just above 90. So this is really a scary time, and I'm going to talk a little bit more about how that can happen and why in a little bit. But it's also scary because this is the fastest drop of more than 30% we've ever seen. We dropped now 35% from the previous high in a month, basically, and we were down over 30% from top to bottom in a few weeks. Now, we did get a good part of that back today, but still, it's a huge drop. All right, so let's consider how bad markets are expecting earnings to be, which is really what we want to be looking at. All right, so historically, there are three types of bear markets. The first is what you might think of as cyclical bear markets. They occur in the normal process of economies coming out of recessions. Demand was low, capacity utilization low, wages are low because a lot of unemployment. And then as the economy grows, we use up capacity, unemployed get put to work, and now companies can raise prices, wages go up until you reach sort of a maximum capacity, and then all of a sudden prices can take off. We get concerns about inflation genie out of the bottle. The Fed comes in and tightens monetary policy like it did in the late 70s, early 80s, and the economy turns down because of that. That type of cyclical recession bear market tends to see earnings drop in the 40 to 60% range and top to bottom recovery of about 3 to 4 years. Second type is a structural change like we had in '08. There, they tend to be a bit steeper. Could be earnings down even a bit more than the 60, top of the other range, and recoveries take a bit longer, more in the, call it 4 to 5 year range. And again, those are averages. So some could be longer, some are less. The third kind is the kind we are experiencing today, which is an event-driven one, like think of 9/11, okay? So let me give you an example. And by the way, in that type of events, the average is 30%, which is sort of where we are today in stock prices. But we're talking about earnings drop about 30%, and earnings recover in under a year on average. I'm not making a prediction, and some were clearly worse, took longer, some took better. But let me give you some examples. From 2006, we peaked in earnings at 88. We didn't get much of a drop in '07 because the recession didn't begin until near the end of the year. So earnings were at 83 by '07. By '08, they were down to 50. So there's your big sharp drop. By 2010, they were above already where they were in '07 and just slightly below by 3% where they were in '06. And by 2011, we were at a new high of 96. So there you're talking '08 to '10 or '11, 2 to 3 years. That was in the worst financial crisis we had, the worst recession we had since the Great Depression. And there's nobody I know of who's forecasting this to be that type of a recession. Most people are thinking more of likely more V or U shape and not the depth here, although one quarter, the second, might be much worse. Here we could see unemployment jump depending upon what this bill passes. If they say, if you don't lay people off, we'll forgive your loan, then unemployment won't be as bad. But there is forecast that this Thursday, because we don't have the action yet, you could see unemployment jump new claims to over 2 million, up from 200,000 or so. And next week would be even worse at 5 million. And we could see GNP in one quarter drop. I've seen estimates from as little as 5% to as much as 17 now. But most then forecast third quarter would be not as bad. It might continue to go down, but we'd be bottoming, and then fourth quarter recovering. Here's an example of the event-driven earnings drop. In 2000, earnings were 56. By '01, they were at 39. By '03, they were 55. So just 2 years later, pretty tough recession. We shut down the economy for at least a while, right? And yet we had it pretty much recovered. Now you have to remember this recession is a public health driven one. It is not a financial crisis of any kind. And as I said, the banks are in much better shape. Okay, so now let's look at, can we estimate what the market is telling us earnings are likely to do? And this is going to get a little technical. I'm not concerned if you can't follow it. Hopefully some of you will be able to do it. But there's something called a dividend strip. So what you can do is buy the dividends of, say, the S&P 500 for any period. Let's say you want to buy them for the next 10 years. That gives you a pretty good measure of how people think corporate earnings would do, because earnings and dividends tend to move over time together. So there was a study done by an investment bank. They looked at that, and you have to make some assumptions and estimates, but based on their analysis, they're saying the market was expecting the S&P earnings to drop 40%, which would be bigger than the average event-driven earnings drop, which was 30. And then it would bottom out not till 02. So 3 full years, much longer than the average, which was less than a year for other event-driven. And also it will not recover. It would remain flat for a decade. So it would stay down till 2030. Nobody has a clear crystal ball, but that seems that's like a panic-driven number where it just doesn't make sense based on history. It could turn out to be right. I can't preclude that, and nobody else can. But it seems to me the market is being overly pessimistic about that. So you need to be aware of that. All right, so we now have that the market has crashed beyond what might be, based on history, illogical. So what's going on? And here I want to now shift to teaching or talking about the differences between how investors think about investing in the stock market in normal times and how they think about it during these current times. So there's a difference in the concepts between risk and uncertainty. Risk is where we can measure the odds exactly where of some event happening. Like if you're at the roulette table, you know exactly what the odds of hitting a particular number are. If you're a card counter and playing poker, you know exactly what the odds are to draw to that flush or straight or whatever it might be. And if you're in the insurance industry, you can't know the odds exactly. Say, if Tim goes to buy a life insurance policy, they can look at the actuarial tables and say, here are the odds of someone who's healthy, keeps in shape, doesn't smoke, etc., like Tim at his age, him dying in the next 10 years because he wants to buy a 10-year term policy, they could price it. Now, it's not a perfect determination, because you could have something like a global pandemic and could cause more deaths than necessary. On the other hand, I'll point out, just to keep in mind here, this pandemic is clearly going to lower deaths from car accidents, people dying from lots of other things, crime probably, who knows what else. So nobody knows what the exact issue would be. But there we have pretty good ways to come up with very good estimates of the odds. Nobody can tell me what the odds of a 9/11 event are. Nobody can even estimate what the odds of a global pandemic of this kind really are. They're black swan events, if you will, in that sense. So here's what happens. During normal times, we tend to think as investors about investing in terms of risk. What are the odds of a bear market happening? Well, you can look at history and say it happens once every 5 years or so. And we get a correction of at least 10% almost every year, which is why most people don't panic when it's only 10%, but then start to panic when it gets much worse than that. we just don't know when we get things like this and we can't see clarity. There's no way to know how long this might last. There's no evidence from history of dealing with stuff like this. We begin to think of things as if they are uncertain, when the reality was they were always uncertain. But we change the way we think, and our stomachs get roiled up and become nervous. And what happens is, ask yourself this question: would you rather make a bet or an investment when you know the odds of something, or when at best you could make a rough estimate at best? I think we all agree you would much prefer the former. And when the latter environment occurs, we raise the risk premium we require to invest in stocks. And so what happens is, think about an equation where you're determining the value of a company. We know the earnings are dropping, and we can estimate it based on history. Maybe we assume they're going to drop 30%. Okay. If nothing changes with the denominator, stock prices drop 30 or 40%, whatever we're putting in. The problem is the denominator is the discount rate we apply to those earnings based on our fear factor. Right? So emerging markets are riskier than US stocks, so they get a higher discount rate. Well, when we get in an uncertain environment, we raise that discount rate, so you get a double whammy: earnings going down and risk premiums going up, and you could get crashes. And markets can start to fall for much worse even than the economic news. They will fall before the economic news even happens as well. So I'm going to touch on those issues now to help you think about this. So first, we want to make sure you understand that whether news is good or bad going forward is virtually irrelevant. And that's a problem for most people in thinking about that. But news is new information by definition. And if you're worried about the markets and what's going on, etc., everything, if I ask you, what do you worry about? I would tell you everybody else on this call is likely worried about. So are the big and pension plans and Warren Buffett and all these traders and hedge funds and everything else. In other words, that news is already in the market, and it's only if the news is worse than expected should the market likely go down. That's how the markets operate in normal times. And good examples of that, I remember during the Great Crisis, companies were coming out, earnings down 20%, and stocks would jump the next day up 15%. Clearly down 20% is a bad number, but earnings were much better than expected, or not as bad as expected, and therefore prices went up. All that matters is now, is the news going to be better or worse than expected? What did we get today? The news was better because Congress looks like it's going to act. Yesterday, they thought they'd have a package Sunday. It didn't happen. That news was worse. Markets went down. Today, the reverse is happening. We see the same thing, by the way. I've seen a company announce earnings up 100%, and the very next stock price was down 40% because the news was not as good as expected. So keep this in mind. It is irrelevant whether the news is good or bad. We know that the cases in the US are going to continue to go up. The question is, will they go up more than we already anticipate? Second main point is stock markets are leading indicators. What do I mean by that? Well, you've heard this old adage or joke: the stock market has predicted 12 of the last 6 recessions. So yes, stock markets tend to go down well before the economy does, but they often go down and the economy doesn't go down. If you doubt that, just think about the fourth quarter of 2018. Market dropped 25% and the economy continued to roar. In the summer of '98, there was a crisis in Asia. Long-term capital, big hedge fund was threatening to take down the whole banking system. Stocks dropped 25% in 2 months. I mean, a crisis similar in magnitude to what's going on here. And there was no change in the economy. Economy kept growing, and we got the rebound in the fourth quarter, basically recovering almost all of the damage, if you will. And here's the last one I'm going to give you, and I want you to think and hopefully remember this one. So we all remember the great financial crisis in 2009. The economy didn't bottom out. We know today officially the National Bureau of Economic Research said the recession, which is 2 consecutive quarters of GNP decline, bottomed and turned in July of 29. Now the unemployment rate kept going up, right up to 10%, right through the end of the year, hung there for a while before starting to recover. You might remember that the stock market began to recover, and very sharply on March 9th, almost a full year, 9-10 months before the unemployment rate stopped going up, let alone before it came down to any reasonable level. So keep that in mind. Likely what is going to happen here, because it happens almost all the time, the economy will continue to do poorly because of this. The data will look bad, and that'll make you nervous, but it doesn't mean the stock market is going lower. It should only go lower if the news is worse than expected. And we, as I said, we're pulling out all the big guns here. Okay, so we've seen now that earnings after event-driven recessions tend to recover quickly, well before earnings do. And again, a big differentiator between now and 2008 is the banking system is much stronger. The Federal Reserve has provided all this liquidity, and the federal governments, and not just in the US, these things are happening, all around the world have pulled out the big guns. All right. And that's because they learned those lessons from 2008 and have now begun these massive buying programs. So I want to talk now about why markets can sometimes appear to crash when there's even no more bad news, or crash much worse than seems logical based upon the earnings damage. And this is an important process to understand, and I hope it will keep you from committing what I consider to be portfolio suicide, which is panic selling. Because as I mentioned earlier, there's never a green flag that will tell you it's safe. So here's what happens. As I mentioned earlier, we get a drop, even in most good years, of at least 10% during that year. That's most good, even good years. So most people don't panic and sell then. But then we get up to something like a drop of 15%. The news continues bad. And some investors who aren't working with a good advisor like your host don't have that well thought out plan, knowing that these things happen with great frequency. They have a problem because their stomach reaches what I call their GMO point, where their stomach screams, "Get me out." And there's nothing Tim or Matt could do at that point to convince them likely of staying the course, because battles are won in the preparation phase, not on the battlefield where the guns are going off and your nerves are rattling. You have to be prepared. So they panic and sell because they're not prepared. And you get a whole cohort of investors who sell, and that drives prices down. And then you get the second cohort. Prices were down 12%. Now they're down 15, another cohort, and now it's down 17. And then you get a second round of selling because you have people who are too aggressive. In my opinion, you should never be buying on margin. Many people are there because brokerage firms want you to take out a home equity loan. And so you could buy this stock, the markets are great. And now you've got way too much risk. You even put your home at risk. No one should be buying on margin, in my opinion. At any rate, They now get that dreaded margin call and are forced to sell typically because they don't want to put up more capital in a crashing market. So they sell and more GMO points are hit. And then you get the third ingredient, which is momentum or trend following strategies. So how does that work? Going into this year, the markets were rising for a whole year. So when the markets are rising, they are long. Let's say you're a fund and you're 100 million of assets. They miss the turn because there's a signal. It takes time for that to turn, but eventually the markets drop depending upon the nature of your signal. It might turn in 2 weeks, it might turn in a month, but eventually it hits that turn and you go short. So not only do you sell your 100 million, you have to sell another 100 million to go short. And so they cascade, causing more selling, more GMO points, more margin calls. And we're seeing that in the amount of margin dropping rapidly now. And so we know those people had to cover and sell equities. We've seen a massive amount of capital leave. But we're not done yet here. You have a problem with investment firms who use a very good strategy, very rational. It's called risk parity or value at risk. And here's how they work. They look at portfolios and want to create portfolios that highly diversify across many different types of risk. Because we believe, for example, that because markets are efficient, then all risky assets should have very similar risk-adjusted returns. Not same returns. Emerging markets are riskier than US, so they have higher risk-adjusted returns. Or you could think corporate bonds are riskier than treasury bonds, so they should, in theory, have higher returns, but not higher risk-adjusted returns. If something had a higher risk-adjusted return, capital would flow into it, driving their prices up and their expected returns down. And the ones that were low expected returns, capital would flow in, driving their prices up the other way until you get the equilibrium. Sorry, if someone had low expected returns, capital would leave, driving prices down, and then you get higher expected returns. Okay, so what's happening here? Pretty simple math. I think everyone will be able to follow. Say you've got a portfolio with 2,000 risk points here. Let's make it 5,000 to make the math easy. So I'm willing to put 5,000 points of risk. So I've got $100 million I want to put in equities, and I've got, well, let's say $100, and I got a volatility of 20. That's 2,000 risk points. $100 equity times 20 volatility. I've used up 2 of my 5,000 risk points. I've got $100 in a 5-year treasury. That only has volatility of maybe 4. So $100 there, I've only used 400 risk points. I'm up to 2,500. And I've got $100 in a reinsurance fund that has a volatility of 10. I get 1,000 risk points. And that's how this works until you use up your 5,000. Volatility was at 15, I mentioned, at the beginning of the year for stocks. Goes up to 30. Now you have to cut your equity position in half to maintain your value at risk or risk parity. Then it jumps to 60, and you got to cut it in half again. Then it jumps to 80, and you have to cut it again. And you can see how this leads to cascading selling, even if there's no bad news. It's just all these players are being forced to sell, if you will, either through emotion or mechanics like margin calls and value at risk. And sorry, but I'm not done yet. You have even one more new player here, which I think is contributing significantly to this, and nobody else seems to be talking about it, which is the whole investment community of banks and insurance companies took advantage, if you will, of what happened after 08. So Tim wants to invest in stocks, but he's been scared by the 08 recession and how badly stocks did. So I'm an insurance salesman. I've got this great product, Tim. We're going to put you in it and allow you to earn up to 10% any one year in the S&P, and we'll protect the downside anything below 10%. That's a god-awful product. It's expensive. No one should ever buy them. Much easier and better ways to protect your positions. But the average investor doesn't know that. They don't know how to calculate the math. But a simple example would show that, we know there are many more years where the markets are above 10 than below 10. That's simple. Anyway, these products get sold. What happens? 2019, markets are up, nothing's going on, except that investors gave up the upside above 10%. But the banks and insurance companies who have sold tens of billions of this stuff, and it's not just in the US, they're actually much more popular in Europe. And by the way, the SEC is investigating many of these, and there have been articles written, including by me, that all look at them, and every one of them is a disgrace. Massive fees. Sometimes on average in the order of like 6% you're paying when you could hedge that risk much cheaper and in more efficient ways. So here's what happens. The market drops, they hit that trigger point when it's now down 10%. Now they have to cover their risk. They sold insurance and they don't have any protection. So they have to go into the market. They're going to sell S&P 500 futures if that's the index they were guaranteeing. And they drive markets down, GMO points, margin calls, value at risk, etc. And these things can cycle down. And that's why you get the kinds of volatility and crashes, even though there's no news. It's a lot of it is simple, programmatic, systematic trading and fear. And then one day it all stops because there's no one left to sell. And then the market will turn around and no one may know why. And by the way, the reverse process happens, and it happens just as investors who got out, oh my God, the market's up 15%, fear of missing out, I better get in. The people who were short, betting the market would go down, they have to cover and buy. The value at risk players. Now, I told you the VIX was at 80 the other day, 64 yesterday. This morning I checked, it was in the 50s. They have to come in and buy. They may be today partly responsible for this recovery as well as the news. So you see all these things happening, including the sellers of those structured notes. They were short the market, but it's going up. And once it's above their insurance level, they don't want to be short because they would lose their shirt. So they have to buy. And you can see how we've become much more volatile because of the nature of the markets and how they have changed. What I want to close with here, and then we'll take some questions. I thought we could leave 15 minutes. We're about there, so we'll try to wrap up. Keep this in mind. Today, or let's say at the start of the year, the US, what's called the Cape 10, the cyclically adjusted earnings figure, looks at 10-year earnings, averages them, adjusts them for inflation to smooth earnings through recessions and high points in the market. That gives us the best predictor we have of future real returns to stocks. It's not a great predictor, but it's the best we have. At the start of the year, that Cape 10 was about a little over 30. If we invert it to get an earnings yield, like a bond yield, let's just round it and say it was 3%. That's pretty much where it was, a little higher than that. That tells us the expected real return to stocks going forward over the next 10 years, and well below historical levels. We would add 2% inflation, give you a rough estimate, 5, some people think 6. That's where most financial economists thought stock returns would be. Today, or yesterday, I should say, the same numbers were about 4.7%, so up 1.6 from where they were at the start of the year. International markets were much better in terms of higher expected returns because they had done more poorly over the last decade. Their expected real return was 7.1, I estimated yesterday. Add 2 for inflation, that's 9. And emerging markets was 9 for their earnings yield. Add 2 is 11. Now, you'll have to keep in mind in the context, that's alongside a 0 bond yield or very close to it. Safe investments are going to stay low for a long time. So even if you think US stocks are now only going to get, say, 7 instead of a 10, that's still a huge risk premium, a lot more than historically, because when we were getting 10% for stocks, we were getting, say, 5 for bonds. That's 5% over, say, a 5-year treasury. Today, you would get 7 versus a half. That's a bigger risk premium, and that's what matters. So I want to point out, we do have bad news. It's going likely to get better when, if it's V-shaped, U-shaped, L-shaped, I don't know. But I have faith in our capitalist system and democracy. And if you don't, you should never invest in stocks anyway. So hopefully I've given you better perspective on how to think about this, shown you that there's a light at the end of the tunnel that likely is not the truck coming in the other direction. And Tim,
No, Larry,
over to you.
I appreciate that, Larry. Thank you for walking us through that. So if you missed this in the beginning, if you'd like to ask a question in the bottom of your screen, you can click on the chat button and send over questions. We got quite a few questions before Larry's talk, which he did cover a lot of that. So, so thank you. So one question, if somebody is, and you know, they have a broadly diversified investment plan and they are extremely nervous what's going on, and I've heard a couple different, they're not clients, but people that I've talked to that have said, if I know the market's going to get worse, everything tells us it's going to get worse, should I just go ahead and sell now, wait for it to rebound, even if I miss the bottom, and then get in down the road? What would you say to that?
I would tell them that's about the worst thing they could do, possibly. And I'll explain why. I call that committing portfolio suicide. Because I think the odds are if you do that, there's a pretty good chance that you will never recover. And here's why. I will tell a story, and this is the benefit of, I would say, gray hair, at least where I have it, and lack of it on top, and having lived through lots of crises. I'll relate a incident that occurred around Thanksgiving, just before that in '08. Someone, Tim, one of our clients or some investor, was talking to us. They were experiencing the same thing, asking the same question, and even said to me, I will never forget, Larry, you're going to rebalance me into bankruptcy, because we had rebalanced once when it dropped about 25%. And then we had done it, or about to do it again, because the market dropped another large amount. And I just can't sleep. And I told him I thought the right strategy is that you have learned that you were overconfident about your ability to deal with risk. The right thing is to lower permanently your equity allocation. It's a painful lesson, but it's far better than keep doing it, because you're going to have to live through another 3, 4 of these, and this can get worse. So eat the loss. Instead of being 60% stocks, maybe you should have been 30 or 40, and now you might not be feeling good, but you wouldn't be so panicked. And that's a mistake. We're humans, we make them, but fools repeat them. So if you've made that error, that's the smart thing to do, not dump your whole portfolio. And remember, the market has already lowered your risk, because you're no longer 60% stocks, maybe you're 45 or whatever the number is. So that may already take place. But I would tell you the right strategy is change it permanently. All right, here's what I told him, because he would not do that. He said, I have to get out. I said, okay. I asked him then, can you make your goal sitting in treasury bills? Or even 5-year treasuries, take some term. Well, the curve was flat, all rates were pretty close to 0. He said, no, I can't do that. So he got the point. So I said, obviously you're going to need a plan. How are you going to know when it's safe to go in? And he said, okay, I get it. All right, we'll just wait a month. And if the market, in this case, we'll wait till the end of the year because we're right up to Thanksgiving. If the market is up by the end of the year from where it is now, I'll get back in. And I said, okay, that's a plan, better than no plan, but it's a lousy plan. And I'm take no credit. I wasn't forecasting. I was only pointing out a possibility. And the possibility was this. For no reason whatsoever, economically, or maybe there might be some good news, the market could turn around. Or it could be just that end of that vicious cycle of selling for the moment. You're gotten out and the market recovers. And at the end of the year, you get back in. And then for whatever reason, again, it crashes. And you, in my opinion, will never be able to buy again because you'll be convinced the next time you buy, the same thing will happen. What actually happened was, unlucky for this person, last 6 weeks of that year, the market jumped like 20%. There wasn't really any good news. It was just the panic selling had stopped or whatever. And then in January, again, maybe for no good reason, I don't recall, he had gotten back in around the first few trading days, and the market crashed 25% in the next 9 weeks. And he got out again. Never heard from the person. I don't know what happened, but you can imagine it was highly unlikely. I've met many people who got out in 08, 09, literally met somebody the other day who had $8 million, got out of the market, and today is still sitting in cash. And that person is in their 90s, and their son, who's going to inherit all this money, has been screaming for 10 years, Mom, you can't sit and, but she's afraid that the day she goes back in, it will happen. So the worst thing you can do is to get out, because there's never a green flag. We had the worst economic recovery from a recession in history from 09 through 19. We didn't get a single year till 19 where the GNP was up 3%. Not once did that happen. Unemployment stayed high for a long time. We had crisis after crisis. People forget them. I bet most people forget. I think it was 2010 or 11, we lost our AAA credit rating. We were about to default on our bonds. We had the pigs crisis, Portugal, Ireland, Greece, and Spain. They were all going to default, and Greece did, and they restructured. And then we had Brexit and the Japanese earthquake where their nuclear facility, who knows what that could have turned into. The world was concerned about supply chains all over the world shutting down. Nobody knew. And there were many other crises like the wars in the Middle East. I promise you there was never a single day in the last 10 years where it looks safe to invest. That's the problem. Much better if you learned the lesson that you just took more risk than you could really stomach. It's okay. We're humans. We're not machines. We make mistakes. Have Tim or Matt run a new Monte Carlo, adjust that allocation, and then live with it. And if the market comes back, don't second guess yourself because you don't know. Don't engage in hindsight bias because the market could have gone a lot lower still. There's just no way to know. Nobody does. The best thing you can do is focus on managing risk, not returns.
Yeah, thanks, Larry. So what about rebalancing? How do you view rebalancing right now and with what's going on?
There's no right answer per se to that. I would tell people certainly there's nothing wrong with rebalancing mechanically to your asset allocation. However, investing is much more about temperament than intellect. In other words, your stomach is more likely to determine, or your degree to control your stomach is much more likely to determine your success rate than your head. So you have to keep your stomach calm and be able to live through this. So in 08, we actually had, despite all of the education and doing many of these type of webinars, we had about a third of our clients, anecdotally, we estimate, who didn't rebalance. We lost one client who went to cash. So I felt great because we had a great success rate, even though we failed in the sense that 1/3 didn't rebalance. I gave them a pass, if you will, a get out of jail free card. I said, that's committing a minor misdemeanor with a felony, because it's my terms, committing portfolio suicide, is panic selling. So if not rebalancing is going to allow you to sleep better because you're worried the world is coming to an end, God bless, stay the course. If markets recovered, you didn't get the benefit you should have gotten and would have gotten. And every single crisis we've been through, all 20 of them I've lived through in the last 20 years, the market has recovered. For Japan, that hasn't been the case. 30 years, we're now negative nominal returns for Japan. So I can't promise you anything. I can tell you putting the odds in your favor if you rebalance. So let me offer 2 other suggestions for people to consider that I think are helpful. Instead of rebalancing to your band, to your target, say you're a 50% target, so your band might be 45 on the bottom. If you're down below 45, just rebalance to the bottom, but that's a problem because tomorrow you could be under again if it goes down. So you say, I'm going to live with that for a month. 1 month from today, if it's below, I'll rebalance to the bottom again. So you're only doing a little bit and not going all the way back. And tell yourself, if it jumps up, boy, at least I was smart enough. I did some, benefited, and that helped. I didn't do nothing. And certainly I avoided panic selling. The other option, which I think is another good way to think about it, is I'm not going to rebalance even to the bottom, but I will, let's do 1%, Tim, and come back in 2 weeks or a month, whatever it is, write it down and stick with it, okay? And just do a small amount. So my line here is, we don't believe market timing is a good strategy. The history says that's a bad strategy, and I'll touch on that just in 1 second. But if you're going to sin by trying to time, like not rebalancing, sin a little, right? Do it in small amount. And I've had conversations the other way just yesterday with a bunch of ex-traders who are much more aggressive, and they're saying, Larry, I want to raise my equity allocation from 60 to 80. And I'm saying, okay, I know you're a trader, you've got the experience. My advice is, if you really want to do that, go from 60 to 65. And you can yell at me if it goes way up here, but that would be my advice because you might be wrong. And you told me 60 was the right number in the first place. So here's the last thing for that question. Markets jump incredibly fast, and here's why you don't panic sell. Study was done over a 100-year period. If you took out the best 100 months, so 100 months out of 100 times 100 or 10,000, right? So you have that 100 months, sorry, not of 10, 100 times 12, so 1,200, 100 out of 1,200. If you cut out the returns from those 100 best months, Tim, do you want to give me your estimate of what the total return would have been for the other 91.5% of the months?
Are you asking me, Matt?
Yep.
Oh boy. We'll go with 20%.
0. In other words, if you miss the best 100 months, you got no return on average the other 1,100 months. That's why you don't want to get out. When these things recover, you get days like this. Think of that. Stocks have gotten you 10% on average, right? A year. We got 10% today. Actually, now it's up 11 while we're talking, right? So that's why you don't take these actions. You don't panic and sell. While it may seem logical to you, I'll just wait till I can see the bottom. By the time you can see the bottom in the economy, you're way too late. The market has probably recovered 6 or 9 months ahead of you.
So one of the questions I just came in just now, and I had a client call this morning and said, Matt, I have $1 million that I just sold a property. Is this a good time to invest it, or should I wait? What would you say to that?
All right, I'm going to give you a bifurcated answer because I don't think there's a right one. I can give you the logical one, which is this. Every day that you don't put your money in, you're giving up an expected return to stocks. And it's very simple to understand that. Stocks are riskier, Matt, than T-bills, right? So we invest in stocks despite that because there's a risk premium. That's true every single day, right? That stocks are riskier than T-bills. So it must be true that every day there's an expected return to stocks. And every day you're out of the market, you're giving up that expected return. The right answer to that question was written in a paper 60 years ago by a professor at the University of Chicago named Constantinides. He was asked about, should I dollar cost average and stuff? He said, the answer is simple, no. Pure math says you should have put it in all at once. The problem is, in a market like this, people are fearful, and putting it all at once, they're afraid that'll be the day the market then tanks again. So I think I tell them, hey, here's the logic. If you can live with the risk, go for it. But on the other hand, let me suggest a dollar cost averaging type of strategy along the lines we talked about rebalancing. So let's write a plan and stick with it. We're going to decide ahead of time in the preparation phase of the battle what you're willing to live with. So you might say, let's take your $1 million, let's put in 100 grand every month. And Tim, you go ahead and put it, or you could say, let's put in 1/5 every month for the next 5 months, because most of the times these things tend to be fairly short in nature. Bear markets rarely last much more than a year or so. They do, but typically most of it is in the bottom. So Tim, your client, sorry, Matt, if your client puts in 100,000 of the million, you should ask him, what are you going to root for now? For the market to go up or down? What should he root for?
Down.
Down, because he's got to invest the other 900, right? That's counterintuitive. So here's the way I tell people to think about it. If you decide you're going to do that and the market goes up, congratulate yourself for being brilliant to at least get started. You avoided that freezing up that most people were engaging in. On the other hand, if it goes down, congratulate yourself for your brilliance for at least avoiding putting it all in at once. Either way, you will feel good about your decision, and that will prevent this hindsight bias that people all have, where after the fact, they think it was painfully obvious that that was going to happen, right? And that causes them to engage in the mistake called judging a strategy by the outcome and not by the quality of your decision making, which is the only right way to do it.
Let me ask one last question here, because we are just about at 1 o'clock. One thing that I've gotten from a couple clients and reading some interesting commentary on is gold. The fact that gold has not spiked, which is what the expectation was given the circumstances that we were in. What's going on with gold?
Yeah, this is a classic case of unusual things happen to even very safe flight to quality assets when you get a liquidity crisis. This is actually at least should have been expected, although it wasn't certain that would happen, where markets are crashing and people just have to raise cash for whatever reason. Or they're saying stocks are down, I'm an endowment, and I've got 10% in gold and 90%, to make an example, in stocks. Well, now I'm 70% stocks and 50, and the rest gold. So they sell gold to buy stocks. That's one thing. But people just need cash. And so they have to sell anything that's liquid. What we're seeing today are crazy things, typical, and they present opportunities, by the way. So, for example, municipal bonds of the kind quality we buy, AAA, AA, only GOs, general obligation, essential service bonds, they normally trade at roughly 80 to 90% of the equivalent treasury. So if the treasury bond was yielding 1%, a T-bill of 10 years might have yielded 90 basis points, 0.9%. this crisis led to people just dumping munis, and there would be no markets. No one was willing to put in bids. We were getting yields this morning of like 150% of the treasuries. So a 10-year treasury might have been 80 basis points, and a 10-year muni might have been 250. We were even looking at buying municipal bonds in IRAs because the yields equivalent would be like 4.5% of a taxable bond. I mean, it's crazy what's going on, and you could take advantage of those things. So the point here, it is not unusual to see in a liquidity crisis, typically thought of as flight to quality assets, do not go up until the crisis in liquidity ends. Once that ends, and my guess is we might be nearing that because of all the actions the Fed has taken, it might take a couple of more weeks for that to clear, and things will return to more normal. And you would then see things tend to trade with more normal correlations.
Can I, well, ask one more question since you just talked about the Fed. What, and I've had this question a couple people over in a private chat here. What is the long-term impact with this $2 trillion stimulus with low interest rates? What could the impact be long-term?
All right. Again, I'm going to refer you, so I want you to hear it about me also. I think I mentioned I've done a whole bunch of these, so I may have be mixing them up. But I think I mentioned earlier, if someone tells you what's going to happen, you should ignore them because nobody knows. You have to think in terms of probabilities, okay? So a smart forecaster might say something like this. I think there's a 20% chance of a V recovery, where it lasts 2 quarters and boom, we come out of it. There's a 70% chance we get a U-shaped recovery, where it takes 2, 3 years, 4 years to come out of it. But things will get better fairly quickly, or at least they'll bottom out. And then there's a 10% chance we get that L shape, we look like Japan. One of the problems for Japan is much older population. They don't have the immigrant population to keep their age demographics favorable. That's created big stresses on their social blankets, like Social Security types of programs. And they've been running massive budget deficits, much worse than anything we have, and trying to get out of their crisis. That has led to tremendous fiscal stimulus, which has not worked, partly as a vicious circle here. And their Nikkei, which was at 40,000 in 1990, is, last I looked, and I don't know where it is today, was like 18,000. So 30 years, now that doesn't count dividends, but even with dividends, no return basically. We are approaching the level of 100% debt to GDP, which is kind of an area where it seems to start to have an impact on your ability to grow your economy because of all that debt burden. People react, they become concerned about Social Security, which is already in a serious problem. So they start to save more and they don't spend, right? And that impacts economic growth. And the government crowding out other borrowers creates this problem. So there is some chance that you could see a longer U curve because of that if we don't turn this around quickly. And there's even that, call it some small chance of that L curve. We're not near Japan, which has 250% plus GDP. We're right around 100. But this is 2 trillion stimulus. Maybe it will be more even. We don't know. So my best guess is it does act as some drag. How big? This is a new experiment for the US. Don't know how long and how big, but my guess, if we turn it around quickly, it won't be too bad. It might subtract a small percentage of a point from long-term growth, but it could get worse than that.
Okay. Okay, well, we are at a little after 1 o'clock. Larry, I greatly appreciate your expertise and wisdom during everything we are experiencing right now. I appreciate everybody else that's on the call. If you have any questions, feel free to reach out to myself or to my dad, Tim. We are here for you guys, and we will talk to everybody soon. So thanks again, and we will send this recording out later today, okay? Thanks so much. Hope everyone has a great day. Bye.